I've been moderating the Innovation in Wealth Management Summit here at Glazers Hall in London. We've been talking about artificial intelligence, the digital transformation of the wealth management industry. After this, we'll be filming the Debrief video across the river at the Financial Times headquarters near St. Paul's Cathedral, with a panel of pundits discussing today's analysis of the events in the wealth management industry. So please join me for the Debrief video. Hello, ladies and gentlemen. Joining me for our special Debrief show in the FT studio, I would like to welcome three experts in digital transformation who have all been watching yesterday's discussions at the Innovation in Wealth Management Summit here in London. Visiting us from Zurich, we have our two digital doctors. Dr. Sandra Daub, next to me, Head of Business Development at Numena Digital and lecturer in disruptive technologies. Welcome, Dr. Sandra Daub.
Thank you, Yuri. It's a pleasure to be here.
Thank you. And on the far side of the bench, also a digital doctor, Dr. Sigrid Unselt, data architect and CEO of Scylla Consulting. And in between them, from right here in London, Philip Watson, until recently Chief Innovation Officer at City Private Bank, and now a technology and investment consultant advising wealth managers. Great to have you with us, Philip.
Absolute pleasure. Thank you, Yuri.
If I can start with you, Phil. On the commencement yesterday of the proceedings, we had a keynote interview with the Julius Baer interim CEO, Nick Dreckmann. He told us that the main hurdle to the adoption of new technologies was often the timing.
I have seen in our industry or in general in technology, fantastic solutions and fantastic functionality, but the timing was wrong. The market wasn't right, or the clients or the users were just not adopting it and wanted to use it. So I think to find the right moment in time and the right adoption rate, I think is the biggest challenge, I would say, when it comes to innovation.
Mm-hmm. You know, just in terms of being too early for a minute, firstly, that may reflect a desire by the organisation to adapt quickly and rapidly to something which they see as a grand opportunity, and perhaps they've prioritised that over the need for testing, for incubation, for some of the processes which you can take to validate a technology. I think on the other side of it, to be late, you know, that may be that someone has not been able to explain in a very clear way what this emerging technology will do.
There was this famous first AI wave about 30 years ago, but then it stopped because probably some of the underlying reasoning wasn't correct. And also the machines were not there. Neural networks, there were examples of neural networks that had 5 nodes. I mean, imagine. So that has really changed tremendously nowadays with the very powerful machines. So it is a different game now.
And we also heard a lot yesterday about the culture of the organisations and how that's changing.
What I think perhaps needs to be voiced here as the most important point is to frame any change in the context of the individuals that it is impacting or expected to impact. So to put it in a different sense, to put yourself in their shoes and to ask yourself, how is the disruption that is being caused to their lives, which is effectively a change for them in their eyes, going to impact them for the better? So what I find frequently with organisations is that, you know, we talk in terms of, we are about to launch a technology that will allow us to improve the client experience, which will allow us to improve our ROTCE, which will allow us to improve our profitability. For the individual that sits there every day who manages their clients, they want to understand how this will help them as much as it will help others, including the business, including other stakeholders, including the regulators.
I think that's fascinating what Philip's talking about, what the technology does for the people, how it's changing particular roles. And if I can bring in Sandra here, we had a lot of talk about how AI can transform the lives of portfolio managers yesterday. And indeed, there were some specific examples, such as this one from the Bank of Singapore's Chief Data Officer, Celine de Cotonec.
Today, whenever you do analytic, 80% of the time is spent on collecting and cleaning the data, and then only 20% in analyzing the data, right? So this whole 80% can be vastly automated by using AI. So portfolio manager can really focus on those, analytic and added value through their expertise and interpretation of what the AI model output is.
I mean, Celine lined it out what's happening. She mentioned that the amount of data, it's not just increasing, it's exploding, to be very honest. So we are really gathering more and more and more data, which gives more insight. But these data need to be cleaned, they need to be analyzed, they need to be structured. And this is where AI really, really brings it added value. That's the strength. AI can cope with massive amount of data. They can clean it. For human beings, that's just not possible. Or let's say, would be much too expensive. So we have a much, much better database because we have a massive amount of data. We have the data cleaned, which all can be done by the AI. Better data means we make better decisions. We have more data to calculate models. We have the power to simulate. We have a broad range of simulation, verifying traditional, but maybe as well, new models. So overall, indeed, that should lead to a better revenues. So the performance should increase. Why do I say should? I think it will increase the performance, but it will take some time because we need to adjust the models. We need to play around with the models to make them better, and as well the portfolio manager themselves need to trust into the new way of working.
There was also plenty of talk, Sandra, about the risks of technology implementation, with Scott Lee, Head of Private Banking and Wealth Management at Alpha FMC, saying wealth management firms are often dragged into a rabbit hole when trying to implement technology. Let's listen to what he said.
Others is they haven't got the skills, they haven't got the bandwidth and resources. So there's lots of reasons, but it is quite common. And I think what I'm trying to say to people is take a step back, understand what you're trying to achieve, what's the outcomes you want, and then make sure you deploy the resources effectively for the right technology for your firm.
Looking forward, what could banks or wealth managers do better is work in more cross-divisional teams to have as well the technology involved, which can scout the market, which can bring in new ideas, what technologies are coming up, what trends do they see, discussing it with the business. The business needs to understand what this technology could bring them. They need to embed it in the business context, but we should as well involve compliance quite at the beginning, that they can take care on a compliance view, what's possible to embed the compliance view in the innovation. And I believe as well for wealth manager, they should work with startups, with externals to really broaden their view and then start to foster innovation. Be a little bit experimental, go for POCs, but nevertheless always seek as well to bring stuff into production, because this is where you really generate the added value.
And there was also talk about the risk of not using AI, Sigrid. We heard Professor David Schreier from Imperial College, University of London, and he spoke about some of the costs of not implementing the new technologies in this video clip.
There are several risks around AI. The most salient risk is cultural risk, is mindset shift. So the barrier to firms taking advantage of AI technology is not the technology. It is the people within the firm being slow to adopt the technology and use it properly. So that's the first risk. It's a human capital risk. The second risk, closely related, is a cybersecurity risk. So more than 2/3 of cybersecurity breaches are due to human error or action rather than to technology. That's going to be worse in the age of AI. The third risk is improper implementation of AI. So we need to have human-in-the-loop AI. We need people to make sure that the decisions being made by the AIs are correct and proper and compliant. And so what people sometimes do is they either trust AI too little, and so they have what's called algorithm aversion. They won't listen to the AI, or they trust it too much. They put on autopilot and they crash into a wall. We need to have a balance, and that requires AI literacy. So the common theme across all of the risks is human capital and getting people smarter about what AI can do and what it can't do.
But the problem is, especially within IT departments, that they might not really be very successful because the education of the IT people might not be up to the point. The IT departments in big banks, in the banks, that's not where the music plays. So I think the big tech companies have an advantage because they attract all the good people, and for IT departments within banks that is really very difficult. What was tried sometimes and was never successful is to set up within the IT departments like IT innovation camps or things like that. It never worked because of the competition within the IT department. So that is quite a problem. The other problem, of course, is the legacy systems. Integration of new application or new algorithm within the legacy system environment is very difficult and very costly, which also means that a lot of the data that is available cannot really be made available because it's in several layers of systems and very difficult to extract and use successfully. So.
And the pace of the innovation, we all talk about the fast pace, the breakneck pace, the digital revolution, but there is a danger of implementing too much too soon, too many initiatives. And this is something which Ijeoma Okoli, co-director at the Digital Economy Initiative, spoke about, Sandra, because she gave a stark warning about some of these risks.
But I think also professional organizations like the accountancy profession, the legal profession, that require those kind of professions that require their members to have continuing legal education classes to continue to upskill. I think it's also incumbent on them to offer courses so that their members can actually get up to speed in terms of the risk, what's going on, the innovations, and then in turn educate their own clients as well.
Can this issue, Sandra, of fraudsters staying ahead of the regulations always be an issue when it comes to innovation?
If you change something, it always be a certain risk. But I think the most important thing is we need to be aware on it, and then we can cope with it. So tokenization will be a reality. I think it gives us so much opportunity, and we could just say it's too risky so we don't do it, but others will do. So let's take that opportunity, be aware on the risks. And we had as well all this discussion about regulation, etc. Regulation will come. We in Switzerland, we have a little bit of benefit. We already have quite good regulation for tokenization, but as well Europe will bring in the next step of regulation. That will help to secure it. That will make it more secure. But there are so great opportunities with the tokenization. You have the opportunities to democratize alternative investments. You have with all the fractioning, with secondary markets. This is just the beginning of a great journey. So this is making stuff accessible for a broader range of investors. But you could think in a next step with digital assets, you have the opportunity to be much more efficient because you can automate the whole processing, which makes all the back office cheaper, which makes the products even more attractive because you get more return.
I mean, I just wanted to echo that I think looking at each of these discreetly is also another risk that is emerging today. So you might have a group of people that have been instructed to help empower the organisation with tools for AI. You might have another group of people that have been told to empower the organisation for tokenisation. Another group of people that are, how are we responding to, to the rise of big data and GPU strength, etc. And all of those people are independently working on their own topic, and all of a sudden, you have this myriad of competing priorities, of which many of them have not, understood and valued the alternatives, or those which are very complementary to them. So I think there is another risk here. Actually, it's the number of competing emerging technologies today that are actually not competing. That's my point. They're not competing. They should be thought of as being deeply symbiotic and connected with one another.
I think what both Sandra and Philip are saying begs a broader question. Who is the innovation actually for? Who does it benefit? And we had a lot of discussion about this yesterday. Is this for the benefit of the client? Is this for the benefit of the wealth manager? Is this for the benefit of the shareholders of the banks, for the intermediaries, for the outsourcers, for the technology companies? It's not always clear who is the ultimate beneficiary. And on the sidelines of the discussion, one of our prominent visitors, digital marketing consultant April Rudin, who also sits on our panel of Wealth Tech Awards judges alongside your good selves, talked about the mantra of client centricity in the industry. Let's hear what April says.
In today's session in Innovation and Wealth Management, I was surprised to see during some of the polling, especially in AI, where there were three answers asked to the question, how should AI be deployed within organizations? Should it be deployed for internal operational reasons, for externally for clients, or for both? I think the number was something like 72% of people answered that it should be for both. 22%, something like that, or 26% said that it should be deployed for operation, and actually 0% of people said that it should be deployed for clients. So I think there's a lot of talk about client centricity, but it might be a buzzword and not a lot of action around it.
But I look at that and I think somewhat differently, which is that it starts and ends with the client. Everything starts and ends with the client. If the client is dissatisfied, if the client has the choice as to whether to continue to engage you, to continue paying you, and the only factor that really matters is the client satisfaction.
We've been filming the debrief analysis video following the Innovation in Wealth Management Summit. We've been speaking about artificial intelligence, about tokenization, and about the management of data, addressing also key questions about cultural change and about the risks of not investing in AI. But there's one key question that keeps emerging in the discussions of our pundits. Should the changes, the inspiration be coming from within the wealth management industry or from the startups and the big techs outside it? The answer from our pundits is that it must come from a blend of both. I'm going to start preparing for our next event, the Global Wealth Management Summit, to be held in November, and I look forward to seeing you there.